In this video we will briefly know about profit and loss statement or the income statement.
What is a profit and loss statement?
A profit and loss (P&L) statement, also known as an income statement, is a financial statement that summarizes the revenues, costs, expenses, and profits, losses of a company during a specified period. These records provide information about a company's ability or inability to generate revenues, manage costs, and make profits.
How profit and loss (P&L) statements work.
The P&L statement is one of three financial statements that every public company issues on a quarterly and annual basis. Along with the balance sheet and the cash flow statement, it is often the most popular and common financial statement in a business plan, as it shows how much profit or loss was generated by a business. P&L statements are also referred to as 1. Statement of profit and loss. 2. Statement of operations. 3. Statement of financial results or income. 4. Earnings statement. 5. Expense statement. 6. Income statement. The P&L or income statement, like the cash flow statement, shows changes in accounts over a set period of time. The balance sheet, on the other hand, is a snapshot, showing what the company owns and owes at a single moment. It is important to compare the income statement with the cash flow statement since, under the accrual method of accounting, a company can log revenues and expenses before cash changes hands. It begins with an entry for revenue, known as the top line, and subtracts the costs of doing business, including the cost of goods sold, operating expenses, tax expenses, and interest expenses. The difference, known as the bottom line, is net income, also referred to as profit or earnings. P&L comparison. It is important to compare income statements from different accounting periods. The reason behind this is that any changes in revenues, operating costs, research and development, R&D, spending, and net earnings over time are more meaningful than the numbers themselves. For example, a company's revenues may grow on a steady basis, but its expenses might grow at a much faster rate. Comparing one company's P&L statement with another in the same industry that is similar in size can further help investors evaluate the financial well-being of a company. For example, doing so might reveal that one company is more efficient at managing expenses and has better growth potential than the other. Types of profit and loss statement. A P&L statement may be prepared in one of two ways. These are the cash method and the accrual method. 1. Cash method. The cash method, which is also called the cash accounting method, is only used when cash goes in and out of the business. This is a very simple method that only accounts for cash received or paid. A business records transactions as revenue whenever cash is received and as liabilities whenever cash is used to pay any bills or liabilities. This method is commonly used by smaller companies as well as people who want to manage their personal finances. 2. Accrual method. The accrual accounting method records revenue as it is earned. This means that a company using the accrual method accounts for money that it expects to receive in the future. For instance, a company that delivers a product or service to its customer records the revenue on its P&L statement, even though it hasn't yet received payment. Similarly, liabilities are accounted for even when the company hasn't yet paid for any expenses. Why are profit and loss (P&L) statements important? A profit and loss (P&L) statement is one of the three types of financial statements prepared by companies. The other two are the balance sheet and the cash flow statement. The purpose of the P&L statement is to show a company's revenues and expenditures over a specified period of time, usually over one fiscal year. Investors and analysts can use this information to assess the profitability of the company, often combining this information with insights from the other two financial statements. For instance, an investor might calculate a company's return on equity, ROE, by comparing its net income, as shown on the P&L, to its level of shareholder equity, as shown on the balance sheet. Here are the key points from today's video. 1. The P&L statement is a financial statement that summarizes the revenues, costs, and expenses incurred during a specified period. 2. The P&L statement is one of three financial statements that every public company issues quarterly and annually, along with the balance sheet and the cash flow statement. 3. When used together, the P&L statement, balance sheet, and cash flow statement provide an in-depth look at a company's overall financial performance. 4. Statements are prepared using the cash method or accrual method of accounting. 5. It is important to compare P&L statements from different accounting periods, as any changes over time become more meaningful than the numbers themselves.